Um, yeah, so those of you who've been here before, good morning anyway. Those of you, or good afternoon, those of you who've been before, it'll be the same sort of format of presentation. Apologies if you don't like it, but you're getting it, whether you do or not. I'm joined, thankfully, by some of my colleagues in the front row who will hopefully better answer some questions if you have about particular parts of the portfolio later on. And ultimately, as I've always said, this is very much a team process. So the people that are sitting in that front row are very interesting people to talk to about the portfolio. Format's going to follow the same sort of running order, if you like. I'll talk about the market environment that we've been facing. It's been an amazing year again in terms of all the amount of stuff that's going on in the world for us to address as fund managers. I'll talk about the results for last year. I'm not going to dwell too long on those or the performance record long term, really, because I think you'd be more interested in what we're doing at the portfolio level now, going forward, and looking into the future and our views around the outlook. So I will be going quite quickly, but obviously you will have an opportunity to ask questions after the presentation and informally, as the chair said. So what was the environment? Well, I suppose, the first bullet, it's been a challenging period. I think ultimately we've lived through another amazing year. We've had 3 prime ministers in the UK. We've had inflation in double digits for the first time in a long time. We've had a lot of pressure on companies. We've had rising interest rates. So an awful lot has been going on, which has been obviously affecting everyone in this room and also our companies that we invest in. Ultimately, some companies have struggled in the last year, and that's probably not unexpected given the barrage of pressures they've been facing. Obviously the war as well is still ongoing, which is obviously a tragic situation. And we've seen over the last year, we've seen some stocks which have historically been on very high valuations setting off, being derated. That's provided us with some opportunities, which I'll come back to as we go through. But ultimately, some of these small cap stocks that have been historically very highly valued have come back down in value. The pandemic, well, it seems like quite a long time ago now, doesn't it? But ultimately, it's still causing distortions in patterns of trading. We're still working through stock cycles in different industries. That's still feeding through and affecting company results. So that's something we've obviously been looking at all the way through as well. In 2023 specifically, I think we've seen a very narrow stock market performance in North America, where we've seen these technology stocks, the famous 7, I think they're now called, really doing very, very well on the back of excitement around AI and technology in general again. And the smaller end of the market, less benefiting from that ultimately. So we're hoping to see that broaden out, but we'll come back to that later. And then, ultimately, I think there's always potential for a recession. Ultimately, we've seen this huge increase in interest rates. So we have to think a lot about, how's that going to play through into the economies looking forward. The positive thing ultimately is that labour markets remain very strong. I think pretty much most people in this country want a job and get one at the moment. The same in America. There's a shortage of labour in particular industries, and that's obviously supporting the overall economy. So when we look at the performance for last year, you can see on this slide, the numbers actually not huge at the top of the slide. Ultimately, the NAV was a little bit behind our benchmark. And just on that point, just to make emphasise the point, the benchmark that's shown here is the old benchmark. The company has adopted a new benchmark with a higher international element in its makeup going forward into the new year, reflecting the evolution of global markets over time. And that's described in the annual report, but ultimately we've got a new benchmark for the new year. When we look at our performance, obviously disappointed to be a little bit behind the benchmark, but relative to a lot of peer funds, peer investment trusts in smaller companies, that was actually quite respectable. And it was better than a lot of open-ended smaller company funds as well. Not saying we were happy with it, but ultimately it was better than a number of peers. The share price unfortunately went down by more. This is a total return share price, down 6.2 as the discount on the trust widened. Again, that is not unique to this fund. You're probably very well aware. I think around about a third of investment trusts now on the discounts are more than 15%. So, discount at the end of the year was in the high 12s. It's similar as of today. Obviously disappointing that it's that level, but ultimately not a unique situation. And the board continue to buy shares in for more than 4%, 4.5% in last year, and we've continued to do that at the start of the new year. Most positive number on this slide, obviously, is a dividend up 25%. For those of you who like a dividend, you hopefully will be getting your that money paid into your account, subject to approving it in a few minutes. That was a very strong increase in dividend, and that's probably the most encouraging thing I think I can say to you today, is that the companies we invest in deliver us that income, pay out to you, and a lot of them have been increasing their dividend payments strongly. So that's encouraging, hopefully, for the future. At the bottom of the slide, you've got the relative regional performance there. I think I just sort of flag, and I'll come back to talk about this a little bit more in the following slides, but Japan was a very strong market last year. The Japanese small cap market did well. You can see it was up. Our portfolio outperformed the local index. We did 9.1, the local index in grey did 7.7. Japanese small caps have not had a problem in terms of higher interest rates, because there hasn't been any change in interest rates over there at all. So ultimately, they've not been battling that issue. Valuation more attractive probably at the start of the year as well in Japan. So, that small cap market did well last year, and pleased to say we did increase our exposure to it in the early part of the period. And then also on the right-hand side, our rest of the world portfolio mainly focused on Asian markets. So we were quite pleased with the performance there, down 2.1%, plays minus 7.4 for the Pacific ex-Japan small cap peers, index rather. Ultimately, a couple of investment trust holdings that we hold, Scottish Oriental and Utilico Emerging Markets, both did well last year, outperformed strongly. When we look at the next slide, and I'm not trying to get away from the fact that we did outperform in the parts of the portfolio, this is actually the attribution for those parts of the portfolio: North America, UK, and Europe. And these are the top 5 goods and bads, if you like. Obviously, in the annual report, you'll see a very long report talking in more detail about individual companies that did well or badly, but these were the top 5 and bottom 5 contributors in each part of the portfolio there. A couple of points to make on that. In North America, although we underperformed for the year as a whole, we were pleased that we recovered a lot of ground in the second half of the period, and some of the stocks there on the left helped in that process. So Eagle Materials is a cement and aggregates business based in the US, very good operator in that market, and has been in favour in the market as people have become more positive about the outlook for infrastructure spending in North America. So that stock did really well. Focus Financial, I'd just mentioned because it ties in with the UK, a couple of the UK names. Focus Financial is a wealth consolidation business. It was a company that was set up to consolidate wealth management businesses across the US. It found itself subject to a bid for itself during this year and performed well. The reason I mention that is on the UK, we also benefited from takeover activity with RPS Group and Euromoney there. You can see just down in the middle there, both of those companies taken over. Within Europe, the list of companies that did well across different sectors, but I've mentioned the Bank of Ireland. Bank shares generally did well in this period as interest rates rose, and that Bank of Ireland holding we bought at a very good time, and it's performed well for us. Obviously, on the right-hand side of the page, the fund manager tends to not like to talk quite so much about the things on that side of the page, but a couple of points I'd make in relation to this. Ultimately, some of these companies have had problems, individual problems that we didn't foresee, and they performed badly for that reason. But there have also been some companies, such as Max Linear and Fludra at the bottom in Europe. These were companies that did very well through the pandemic period, and maybe with the benefit of hindsight, we should have got out of them at that point in time, because ultimately they've suffered in the last year from a sort of a partial reversal of trends in terms of demand in their markets. So, those are companies these are all companies that obviously have stories behind all of them, but just to mention that the pandemic has impacted some of these stocks. The other thing, and Syneos is on the second line on the right there, that company has actually, subsequent to the end of April, been taken over as well, or agreed to a deal. So, again, consolidation activity on the portfolio continues. I'm not going to dwell on this page for too much longer, actually. I'll move on. Performance track record, again, I'm going to dwell on this. This is just a discrete last 5 years to the end of April. 3 of the 5 years we've outperformed. Obviously, we're slightly behind the benchmark in the last year on the NAV, but 3 of the 5 we're outperforming. The longer term record there again, you can see over the last 5 years, the NAV's just a little bit behind the benchmark. So disappointed by that, but ultimately it's been a period where a lot of smaller company managers have struggled to keep up in this period where maybe the sort of growthier stocks have struggled. And then when we look at the longer term numbers, obviously the NAV still well ahead of the benchmark. The other point this actually does highlight is that although we're unhappy about the discount, clearly very unhappy about the discount at the moment, over a 25-year period, you can see the share price total return has been better than the NAV return, which actually tells you that the discount over that period has actually narrowed. And again, just illustrates that, love it, whether you like it or not, investment trust discounts are cyclical, particularly in the smaller companies sphere. So, over that 25-year period, hopefully some of you in the room have been in all that time. You've made quite a lot of money, hopefully. This slide really just talking a little bit about, or just showing a few companies that we've been investing in over the last 12 months. 12 months actually. This covers a couple of names that we bought in the last couple of months as well. 3 buckets there you can see. So effectively, quality companies at the top there that we think really can grow sort of pretty reliably. So Curtiss-Wright, a name you won't know, but it's an American-based aerospace defense business, also with a position in the energy market, benefiting from strong spending in aerospace defense and also from upturn in spending in the nuclear power industry, actually. Critical components it supplies, we think it's well placed in the current environment to do well in looking forward. Glanbia, Irish listed company, performance nutrition products, good steady, good position in its market, taking share in its core products, Optimum Nutrition. That one's done well since we got involved with that. Maybe dropping down the next line, Pets at Home, a consumer name, obviously you'll be probably more familiar with. Ultimately, that business has done well in the last year, continues to take a very large share of people spending on pets. I mean, I'm there every few weeks myself, loading up on cat litter. And then if you move down onto the next bucket on the left, there's cyclicals with low expectations. I think this is where we think actually now that is particularly interesting, because there are some companies that have been hammered in the last year. They've been derated, and people are very worried about their trading outlook. So building-related businesses, for example, or real estate companies, people have become very negative on those parts of the market. And we think fundamentally there are some really good businesses within those sectors that are now available at much better valuations. So Workspace, a company that we have held on this fund a number of times actually over the years, we've bought back into that company. It's a provider of SME workspace offices and also less traditional sort of office space, if you like. And ultimately it's available today on a very large discount to its NAV. Good rent collection record more recently, and paying out a 5% plus dividend. So, Lancashire also on that page, an insurance business on a very low PE. The insurance industry's had a very difficult last few years, elevated natural catastrophe losses, but they really have put rates up so much now they should make money. Let's hope that's right. And then if you look on the right, we also added to some companies in commodity-related businesses. So it's not a huge part of the portfolio, but at the margin, we've increased our exposure to the energy infrastructure through holdings in Cosmos, which is a producer, oil and gas producer, Vitesse, a North American listed producer, and Sherwood Blackman and TGS, which are on the services side. The other one just worth mentioning is Ashtead, also within that bucket. That's a company that IPO'd in the UK market a while back. It's featured in the annual report. We did a sort of page feature on it. It's not just involved in offshore energy infrastructure for oil and gas. It's actually very much now playing renewables investment around the world. And, again, we think it's got good prospects. So commodities is an area where there's been huge underinvestment in infrastructure in the last few years. Some of these companies should stand to benefit going forward. Obviously, something's got to go out when you're buying things. The top left, I mean, this is not an exclusive list. There are more where the investment thesis we think has been challenged. A couple I'd mention: Sligro, C&C, both involved in hospitality sector. One in mainland Europe, Sligro, and then C&C actually a UK operator. Ultimately owns the Matthew Clark wholesale business in the UK market, supplying the pub trade in particular. that company's really struggled on execution in the last year, and we've just lost faith fundamentally in the management and their ability to deliver. So we've exited that. Sligro, ditto issues with that one. On the right, some companies we just think have just run too far in terms of valuation. So we've taken profit in some of these. Energian, Telecom Plus, Molina. We've taken profits in those stocks. We still own them, but we've booked quite nice profits on them. We like the companies, but we think the valuations have gone up a fair way, and so we took profits on those. The other three we've actually sold entirely. So we did very well in Europe in Alton, which is that outsourced sort of consultancy business. That did really well, got re-rated, and we've moved on. And then at the bottom, you can see the takeovers, 5 takeovers there. That I think, it was a quieter. I think last year I was saying there was a huge amount of takeover activity on the portfolio, about 17. This year it's much quieter, but we have still seen these companies acquired on good premiums. So when we look at where are we now, and so obviously this is actually the end of June, so a little bit out of date still. But at the end of June, the portfolio structure is as shown. You can see the weightings there between the geographic markets and the sectors. Over the year, back end of the year, we took a little bit of money out of North America. We put a bit more money into Europe during the year, and we put a bit of more money, as I said earlier, into Japan. So those weightings have moved a little bit, but not massively so. You can see on the bottom left our weightings relative to our benchmark. This is the new benchmark that we're now operating in, which has effectively got a 20% weighting to the UK. And then on the right, you can see the sector weightings. And again, the message there is a very broadly spread portfolio, not a TMT portfolio. It's a broad exposure to hopefully some of the best companies around the world in the smaller cap sphere. We've added to industrials where we think there is undervaluation, certainly. I mean, it's broad sweeping generalization, but some of the industrials are more cyclical businesses that have struggled in terms of stock market rating in the last period. So we've added some weighting there. Taken a bit of money out of financials, so we have taken some profit in some banks. But yeah, it's always moving around a little bit around the edges. But it is a broadly spread portfolio, and you can see that block of collective investments, which are the funds that we use for exposure to Japan, rest of Asia, and emerging markets. If we move on to the top holdings in the portfolios, these are the leading holdings within the individual regional portfolios. These weightings that are shown are actually the percentage of the North American portfolio in this case. So Eagle Materials is 4.8%, or was 4.8% of the portfolio at the end of June. That's of the North American portfolio, so it's less as a percentage of the fund as a whole. But ultimately, it's just demonstrating we've got a reasonably concentrated list of holdings there in North America. Eagle, I've mentioned already, it's done very well in the last year. Another company I'd mentioned, the Andersons, it's fifth one down. It's an agri play, effectively, on that industry. That's done very well in the last period. Actually, since the end of April, it's performed very strongly. Graphic Packaging is you might say, a very boring company. It's a container board business, but with a very strong position in its market. It's been able to pass through rising costs very, very adeptly in the last period, which has been vital for any company at the time of inflation. So those three I just mentioned, but in the interest of time, I won't dwell any further on this slide. But you can see the weightings of the portfolio where we are skewed relative to the different parts of the market there on the right. In the UK, top 10 names. So Kitwave, not a name that many people will know. This is a company that we backed at the IPO, I think probably a couple of years ago now. This company supplies confectionery and other food products into the convenience store channel. It's a small market cap company. It's not very well known. It is becoming better known, and its shares are up, I think, about 90% in the last year as it's delivered against the expectations that it set out at the IPO. So that's an example of a company that not many people have heard of. A lot of these other names you maybe heard me talking about previously. I mean, Ashtead Technology, which I mentioned earlier, is on there on that top in that top 10. You've got a defence company there, Kinetic. We do like the outlook for the defence sector at the moment. So again, you've got the sector split on the right, where we're overweight to technology and the industrials, where we think those valuations look attractive in some of the stocks. When we look at Europe, again, a lot of these names This is again the weightings of the European portfolio depicted. So quite a concentrated top 10 there. Pretty well spread across sectors. You can see the bank in the number 5 that I always say I can't pronounce. And that one has continued to execute well and perform strongly. As I said, I think we have taken a little bit of money out of the banks. Cast your mind back to March. You probably remember a few American banks going bust and panic in the markets. At that point in time, we did reflect on our weighting to banks, and we did sell one of our holdings in Scandinavia. Not this one, but another Scandinavian bank in the last few months. Ultimately, again, another amazing event to see these banks going bust. But here we are again a few months later, and everyone seems to have forgotten about it. So yeah, the weightings again on the right, you can see the split. Again, quite an exposure to technology here, and quite an exposure to sort of what we think are high quality consumer staple businesses, such as, for example, Lotus bakeries. I think our team in the office continually chomping away on the Biscoff biscuits when we need a pickup, and so hopefully a few of you have started to buy those. But that company's done very well in the period since we've owned it. The collectives, always need to talk about those because they are about 20%, 21% of the fund. In the last year, we sold out of 2 funds run by HSBC in Aberdeen for Asian market exposure. Ultimately, they weren't performing well, and we decided to concentrate down onto a smaller list of investments, as you can, the ones that really are just showing there. Put more money into some of them. I said earlier, so ultimately the really well. That's a value-orientated approach. Value stocks in Japan did very, very well and that's continued at the start of the new financial year, actually. So, that fund remains our biggest holding. Scottish Oriental and Utilico did very well for us last year, and generally, pretty happy with the way they performed. So we move on to how's the new year started. It's always good to be able to turn up to this event with a good start to the year. I mean, what I can say is markets have gone up. It is the truth, unfortunately, that we have lagged the market at the start of the new year, and that's really as a consequence of our North American, our UK performance being behind the regional benchmarks there. There's also a bit of a headwind to us actually at the moment from our asset allocation, because North American small caps have done considerably better than UK or European, particularly European small caps at the start of the year. So, disappointed to say we're a little bit behind at this early stage of the year. Obviously, we'll be working to try and recapture that through the remainder of the year. But these numbers were to the end of last week. I think we have caught a little bit up in the last couple of days. But the markets, it is pleasing that the markets have gone higher. And again, I'll come on to that again in a second. The share price actually now, up to last night's close, is broadly tracking the NAV, so the discount remains not dissimilar to the level it was at the end of the financial year. But moving on to the outlook. So what is the outlook then? I mean, ultimately, it's always difficult to tell, isn't it? Because we certainly didn't predict the amount of interest rate rise that we saw through the last year, a year ago. I don't think I was saying that to you a year ago. And I didn't predict a regional banking crisis. We obviously were concerned about inflation a year ago. It got a lot worse, obviously, as we all know. But the reality is that fundamentally the markets haven't actually done that badly, have they, really, when you consider everything that's been thrown at them. We are of the view that ultimately the interest rate increases that we've seen are going to continue to progressively percolate through the economy, and with a lagged impact. And we're seeing that ultimately in the UK, I guess, most evidently maybe with the mortgage rate situation, where a lot of people have been on fixed rate mortgages, totally oblivious to interest rates going up, and now all of a sudden realising I'm going to be paying a lot more. And that is obviously starting to feed through in the way that they're behaving in terms of their consumption patterns, etc. So that is still coming down the line. we can't be too blasé about that. That is going to impact growth going forward, and that the markets know that. Everyone really knows that. It's but at the moment, the outlook within the forecasts that I look at internally and externally are still for the global economy to still be growing going forward. And in many ways, that's quite remarkable given the extent of the interest rate rises we've seen. But there are still some positive drivers for the global economy, though. Really, at least in part, from North American big lift in North American spending and infrastructure, with the government there really trying to push forward spending on core infrastructure, energy infrastructure. A lot of investment going in areas like semiconductors at the moment as technology moves forward. And we are seeing this trend within Asia, particularly of a move of companies out from China into other parts of Asia. So investment in CapEx in some of these industries is actually pretty positive. So, it's not all doom and gloom around interest rates gonna smash the economies. There are still things going in a positive direction. And the other thing that's positive really fundamentally is the valuations of the stocks on the market. Some of the things that we were unable to justify buying a few years ago, there's more support now, particularly, as I said earlier, in terms of some of the cyclicals and some of the more interest rate sensitive areas, such as real estate, for example, that I sort of look at. But it is evident that inflation and the interest rate outlook are going to be pretty key drivers in the coming period. And are we at peak rates already? Have we already made a mistake, gone too far? We'll know a little bit more about that in a year's time. But the next chart, just quickly, just shows you the various indices, and it's got on it CPI inflation, and then it's got PPI, the producer price index, and producer input prices and producer output prices, and ultimately the grey line at the top is the core CPI, UK CPI, which has just dropped below 8%. We think that's going to continue to drop pretty sharply in the next months because you've got the annualised effect of petrol prices, which shot up in July last year. That's going to drop out. We think that'll begin with a 6 probably next month. So, I think inflation definitely is easing. That's obviously great news from the point of view of hopefully stopping the Bank of England from going too far. But, could there be another energy price spike in the winter if there's a really cold burst? I wouldn't say that that's impossible, but certainly the pattern of producer price inflation, which tends to lead this consumer price index over the years, is encouraging. And you could put a similar chart up for pretty much any country in the world, I think. Valuations, I think always a bit reticent to generalise too much about valuations. The data there, you're probably going to moan about the size of the chart, but ultimately it's supposed to be depicting how smaller company valuations stand in the different parts of the world relative to large caps. So anything below the line on that top chart indicates small caps are cheaper than large caps, and generally they are. I mean, that's probably not unsurprising relative this point in the economic cycle, but hopefully we think that's support for the small cap investment case if you're taking a medium term view. And then at the bottom there's a chart where there's a table showing how in North America the Russell 2000, which is a sort of a smaller company's benchmark, that's looking on various different measures, looking 32% cheap relative to its long term sort of average on a PE basis. It's 27% cheap on a price to book. So varying degrees of cheapness relative to large cap, but I wouldn't bet your ranch on this aggregated data, but it is indicative of the fact that smaller companies are relatively unloved at the moment. And then finally, this if you think there is going to be a recession, and obviously we seem to still be skirting one. I think the European data's come out this morning. France has grown at 0.5% in Q2, which is pretty impressive. The German economy is flat, but Spain's up 0.4%. So, the mainstream European economies are still avoiding recession. The US is growing at about 2.4%, I think, at the last quarter on an annualized basis. So we are not in a recession at the moment. But if we do go into recession, then this table really indicates that in the last 6 times that happened in a North American context, the Russell 2000, the smaller companies index, if you look at the next 12-month column there, it tends to go up by a lot more than the S&P next 12 months average of 21.7. The small cap tends to do 31.7. Now, again, don't bet the ranch on this data because it is illustrative, but ultimately you should expect coming out of a recession, the small caps do better. Your pushback on that could be we're not actually in one yet, so there might be some way to go before you can get support from that. But ultimately, what I think the message from me this morning is that there's a lot going on in the world. There always sort of is. There's still a lot of uncertainty around how inflation's going to settle down and how long interest rates have to be high. We have to be cautious about the outlook for some of the reasons I've expressed, but there does still seem to be, the chance, at least, that there will be more interest in the smaller company sector if we get to this period where people are confident about interest rates peaking out. And I think at that point, I will hand back to the chair.